Hello and welcome to this webinar on monetary policy in 2020. My name's Andrea Brischetto and I'm the Deputy Head of Domestic Markets Department at the Reserve Bank of Australia. One of the things my department is responsible for is implementing the monetary policy decisions of the Reserve Bank Board. As you can imagine, this has been an extraordinary year for us, as monetary policy has responded to support the economy through the coronavirus pandemic. Of course, COVID-19 is first and foremost a major public health challenge. But the measures taken to address the health risks have led to a major economic challenge as well. Large sections of economies, including our own, have been severely disrupted and at times completely shut down. This has been the largest shock to global economic activity since the 1930s. So just as we found ourselves taking extraordinary measures in our everyday lives that have never been required before, so too has been the case for public policy. The large and coordinated response from fiscal, monetary and prudential policy is unprecedented, and it is helping support the Australian economy through these difficult times. As the title of my talk suggests, I'm going to take you through the monetary policy response and the tools that we've used, both conventional and unconventional, to address this incredibly large shock to the economy. To start though, I want to set the scene with how the global economy and Australia entered 2020, because this has had an influence on the monetary policy measures that have been employed to address the challenges we're facing. Then I'll go through the impact COVID-19 has had on the economy and financial markets and explain the package of policy measures that the Reserve Bank has implemented in response. To finish, I'll give you a sense of how we see the economic outlook from here, with the key point being the large amount of uncertainty around how the spread and management of the virus will evolve from here. So let's first look at the economic environment as it was going into the pandemic. At the start of 2020, the economic outlook, both in Australia and abroad, was for reasonable growth. This graph shows in the pink bars the IMF's forecast for global GDP growth as at the start of this year. You'll notice the first forecast bar is 2019, because at that point, the GDP data for the end of last year still hadn't been published. As you can see, global growth was expected to pick up, following more moderate growth in 2019. One of the factors underpinning this outlook was that progress was being made on both the trade and technology disputes between the US and China and the Brexit issues, both of which had hampered confidence and investment in economies around the world in 2019. Turning to Australia, as you can see from the graph, it was a similar picture. Once again, this is showing GDP forecasts starting with 2019 as they were at the start of this year. After slowing over the preceding couple of years, GDP growth in Australia was expected to pick up in the period ahead. We felt the economy was at a gentle turning point, supported by the pickup in world growth and the renewed expansion in the resources sector. Another key factor supporting this outlook, both in Australia and globally, was the very low level of interest rates. Monetary policy had been further eased or maintained at stimulatory levels in most economies in 2019, including Australia. This was because even though unemployment had declined to very low levels, inflation had remained subdued and growth outcomes had disappointed. In the US and UK, for example, unemployment was at the lowest level for 50 years, but inflation had not picked up. This graph shows that it was a similar story in Australia. Now, our unemployment rate hadn't declined as much as it had in other economies. This is because of the large increase in participation as more people entered the labour force, encouraged by the growth in jobs and enabled by structural factors such as more flexible work options and people living longer. But you can still see this trend of declining unemployment, which reduces spare capacity in the economy, but without any inflationary pressures developing. You can see that underlying inflation, as measured by the TRIM mean, had remained below 2% for several years. Now, this is different to the experience we'd had in the past. And we think this combination of low unemployment and inflation is associated with two important structural factors, which are developments in technology and globalization. Both these things have increased competition and uncertainty about the future from the perspectives of both workers and firms. So workers are less inclined to ask for higher wages, and businesses are less inclined to increase their prices. Now, this means economies can sustain lower levels of unemployment without generating inflationary pressures. Now, this is a good thing. But what this constellation of economic events also meant was that most central banks already had very stimulatory monetary policy settings, with policy rates at very low levels when the economic shock associated with the pandemic hit. You can see from this graph that in Australia, the cash rate was already at a record low of 0.75% at the end of 2019. Now turning to the impact of COVID-19 and how this shock played out across the economy in early 2020. From this starting point, as you know, we saw severe restrictions placed on economic activity in many countries as they moved to control the spread of the virus. On the demand side, physical distancing measures and restrictions on people's movements reduced demand for many firms' products and services. And on the supply side, restrictions were imposed on the scale of many firms' business activities, and in other cases, they were stopped from operating altogether. The result was a large and near simultaneous economic contraction around the world. It is the largest shock to the global economy in many decades. And the uncertainty about how severe and prolonged these restrictions would be made the contraction even worse, as worries about the future led consumers to reduce their spending and businesses to reduce investment. Now, the impact on labour markets in particular has been profound. Unemployment has risen sharply around the world, and many of those who retained their jobs had their hours cut. In Australia, the unemployment rate has increased to 7.5%, its highest rate since 1994. In addition to this, underemployment, which records those who want to work more hours in their job, is now 11%. This is the highest since records began in the late 1970s. Now, the latest statement on monetary policy goes into a lot more detail on the impact of the pandemic on all the different parts of the economy and the different economic variables. So that's definitely worth a read to get a full understanding of just how this shock has played out across the whole economy. Now, on top of the health and economic crises, we then had a full-scale financial market disruption in March. As the magnitude of the challenge posed by COVID-19 became apparent in late February and into March, financial markets struggled to reprice financial assets as risk aversion and uncertainty among market participants rose sharply. Risk premiums widened globally, and volatility in financial market prices increased. For example, equity prices fell by 30%. This led investors to sell assets to raise cash in order to reduce their leverage and meet margin calls. There was a widespread sell-off of even relatively safe assets such as government bonds, and this contributed to severe dysfunction in government bond markets, including here in Australia. With far more sellers than buyers, government bond prices fell sharply, which means their yields increased sharply despite the worsening economic outlook. You can see that in this graph, which shows yields on 3-year and 10-year Australian government bonds. Now, normally with a deteriorating economic outlook and likely reductions in monetary policy rates, you'd expect government bond yields to fall. But the opposite occurred in March. Given the role government bond markets play as a pricing benchmark, these strains flowed through to other markets. This led to a widespread tightening in financial conditions when the economy could least afford it. Now, turning now to the policy response to these events. This economic and financial market disruption triggered a coordinated and unprecedented response from fiscal, monetary, and prudential policy. The policy measures that have been put in place are designed both to support the economy through the disruptions from the pandemic and to support the recovery as the virus is contained, or we at least learn how to live with it. In terms of fiscal policy, the government has been providing significant support to Australians' jobs and incomes. JobSeeker and equivalent payments are supporting people's incomes, and the JobKeeper program is helping businesses to keep their employees on where they can. More than 1/4 of Australian workers are receiving JobKeeper. If it wasn't for this support, the unemployment rate would be significantly higher than it is now. In total, around 30% of Australia's working age population is receiving JobKeeper, JobSeeker, or equivalent payments. And that gives you a sense of just how much support is currently being provided by fiscal policy. On the prudential side, APRA has been working with banks to facilitate them supporting their customers, households and businesses, through this period by providing more flexible loan terms, including through repayment deferrals. On the monetary policy front, which is the focus of the rest of my talk, in mid-March, the Reserve Bank announced a comprehensive package of monetary policy measures to support the economy. The focus is on keeping funding costs low and ensuring credit is available, especially to small and medium-sized businesses. The package also included measures to address the disruptions we saw in financial markets in March and April, particularly in the government bond market, given the central role that this market plays in underpinning the interest rate structure in the Australian financial system. As always, our actions are directed towards achieving our overall objectives of full employment, achieving the inflation target, and ultimately the economic prosperity and welfare of all Australians. In the current environment, that really translates to doing what we can to support jobs, incomes, and businesses, and to make sure that Australia is well placed for recovery. So that's the focus of these actions that I'll now explain to you. The Reserve Bank's package of policy measures has 5 elements. The first is reducing the cash rate target to 0.25% and forward guidance that the cash rate won't be increased until we're making sustainable progress towards our goals for full employment and inflation. The target cash rate had already been lowered by 25 basis points to 0.5% at the Reserve Bank Board's usual board meeting at the beginning of March. But following the extraordinary board meeting on the 19th of March, as the COVID-19 crisis escalated, the cash rate target was lowered by another 25 basis points. This took the cash rate target to a record low of 25 basis points, or 0.25%. Now, as you know, the cash rate is our conventional tool for monetary policy. A lower cash rate, which is the market interest rate for overnight loans between financial institutions, flows through to other interest rates, including deposit and lending rates for households and businesses. This then encourages borrowing, investment, and consumption, and reduces incentives to save. It also reduces interest payments on outstanding debt, which helps households and businesses in the current challenging environment. Another thing it does is put downward pressure on our exchange rate, because investing in Australia becomes less attractive relative to investing in other countries. This makes Australian goods and services relatively less expensive than those of other countries, which boosts demand for our exports and reduces demand for imports. But it is worth noting that with borders essentially closed, we can't expect to see much of an effect on trade and services at the moment. So we can expect this exchange rate channel to be muted compared with normal times. Now, as I've mentioned, we've reinforced this cut in the cash rate target with another tool, if you like, of monetary policy, which is forward guidance. So the board has made it clear that they won't increase the cash rate target until we're making sustainable progress towards our goals for full employment and inflation. The idea of this is to give financial institutions, households, and businesses the confidence to borrow and lend and make spending and investment decisions on the basis of these low interest rates. Now, a question that you might ask is, given the nature and scale of the shock the economy is facing, why was the cash rate target only lowered by 25 basis points? Remember, this is the biggest peacetime economic contraction since the 1930s. As you can see on this graph, by comparison, when the global financial crisis hit in 2008, the Reserve Bank lowered the cash rate by more than 4 percentage points. But that was from a starting point above 7%. The difference this time is that interest rates were already very low when the shock hit. The cash rate target is now at 0.25%. The actual cash rate based on market transactions has drifted a little below that and is currently around 13 basis points. Now, I'll explain why this has happened a bit later, but the main thing to know is that it is expected and consistent with our policy aim of keeping funding costs low. The board didn't decide to lower the cash rate target any further in March because they felt that pushing the cash rate even lower would not be particularly helpful in the current environment. While a lower cash rate would put some downward pressure on the exchange rate, we're unlikely to see much pass-through to lending rates from any further cut to the cash rate. In other countries where the policy rate has been reduced to zero or negative rates, most banks have set a floor of zero on retail deposit rates. These banks have judged that it just doesn't make sense, either commercially or politically, to charge households and small businesses negative interest rates on their deposits. That is, to charge them an interest fee for their deposits with the banks. So with a limit to how low banks can drive down the rate they pay for their deposit funding, this also limits how much they can lower the interest rates they charge to lend that money on to other households and businesses. This limits the stimulus that a further cash rate cut would provide. In addition, a lower cash rate may encourage people who rely on interest income to save rather than spend. Another relevant factor here is that a lower cash rate would also lower the returns banks earn on their holdings of government bonds and in their exchange settlement accounts with the Reserve Bank. This would dampen bank profits, and in the current challenging economic environment, where we're relying on banks to help support borrowers and keep credit flowing, this wouldn't be helpful. So that's why the cash rate target wasn't cut further in March. As I noted before, most economies were in the same position as Australia, with interest rates already at very low levels when the COVID-19 crisis unfolded. And that's why we've seen central banks responding with both interest rate cuts, what we call conventional monetary policy easing, as well as with unconventional monetary policy measures. And this brings me to the second and unconventional element of the Reserve Bank's policy package, the introduction of a target for the yield on 3-year Australian government bonds of around 25 basis points. In addition to our usual conventional practice of targeting the overnight cash rate, We've extended this by also targeting a risk-free interest rate further out along the yield curve to make sure funding costs are low. So rather than just relying on the cash rate to anchor risk-free interest rates at this longer horizon, we're targeting them directly as well. We've chosen the 3-year horizon as it influences funding rates across much of the Australian economy and is an important reference rate in financial markets. Unlike in other countries, in Australia, household loans and mortgages and funding instruments of banks and businesses are either at variable rates or fixed at a fairly short horizon of a few years. Longer horizons, such as 10 years, are more important for government funding markets. By targeting the 3-year yield at around 0.25%, it is also reinforcing the board's forward guidance that the cash rate won't be increased from that level until we're making sustainable progress towards our goals for full employment and inflation. And the board expects this to be some years. To achieve this yield target, we're prepared to buy government bonds in whatever quantities are needed. Now, there are a number of important things to note about our bond purchase program, and I'll take you through them now. The first is that we're buying bonds in the secondary market, not the primary market. As an independent central bank, it is important that we retain the separation between fiscal and monetary policy. We do not finance the government. Instead, the government finances itself in the market. Nevertheless, it is true that our bond purchases are affecting the market price that the government pays to raise debt, just as they're affecting the price that the private sector pays to raise debt. And this is indeed the point, to lower funding costs right across the economy. Now, the second point to note about our bond purchase program is that what we're doing is not quantitative easing, or QE, which unconventional monetary policy is typically associated with. Now, there is a quantitative aspect to what we're doing. Achieving the yield curve target does involve the Reserve Bank buying bonds and an expansion of our balance sheet. But we have not set objectives for the quantity and timing of bonds that we will buy, as some other central banks have done. Rather than quantities or the size of our balance sheet, our focus is very much on the price of money and credit, which is what the bond yield reflects. This is because keeping the cost of borrowing low is the aim of our policies. How much we need to purchase and when will therefore depend on market conditions and prices. Now, the third point I wanted to note about our bond purchase program is that our bond purchases also have another aim in addition to the yield target, and that is to support the smooth functioning of these important markets. As I mentioned earlier, government bond markets serve as the risk-free pricing benchmark for most financial assets. It is also important that bond markets function well so governments are able to finance their fiscal stimulus. So we have bought both Australian government bonds and semi-government securities, that's those issued by the states and territories, out to 10 years maturity as required to address dislocations in these markets. And we're prepared to continue to do so if required. Now you can see from the RBA purchases lines on this graph that to begin with from late March, we held large and frequent bond auctions for Australian government bonds or securities, what we call AGS for short. And we were also buying semi-government securities, what we call semis for short. We were conducting these purchases both to bring the 3-year AGS bond yield down to the target, as well as to address the dislocations in government bond markets. But as the 3-year yield settled around the target rate and liquidity returned to government bond markets, we were able to reduce the size and frequency of our options. You can see the RBA purchases lines levelled out in early May, as we tapered our purchases in response to the much improved market conditions. Now, in recent weeks, we've again purchased AGS. This was in support of the yield target, as three-year AGS yields had settled at a level a bit above 25 basis points for an extended period. To date, we've bought $46 billion of AGS and $11 billion of semis, and we continue to stand ready to purchase bonds as required in support of the yield target and to ensure the smooth functioning of these important markets. What you can also see on this graph is that both the Commonwealth and state governments have been issuing sizable amounts of debt to finance their fiscal support measures for COVID-19. This has been readily absorbed in these markets. In other words, there's strong demand to buy this government debt, and these markets have been functioning well. This is the graph I showed you earlier of 3- and 10-year AGS yields. You can see how the spike in yields in March was unwound. This was because our bond purchases helped to restore liquidity and normal functioning in government bond markets. You can also see how the 3-year AGS yield stepped down as the target was introduced with the policy package. And we also undertook bond purchases in support of it. It's also worth noting just how low these yields are. The government can borrow for 10 years at an interest rate below 1%. Moving now to the third element of our policy package, the RBA has announced a term funding facility, or TFF for short, for the banking system, with particular support for business credit, especially to small and medium-sized businesses. Banks, or more precisely authorised deposit-taking institutions, or ADIs, can get 3-year loans at a fixed interest rate of 25 basis points. Now, technically, it's not a loan, but a repurchase agreement with us, where they have to give us high-quality collateral against the amounts borrowed. Banks have up until September to borrow as much as 3% of their total credit outstanding at the start of 2020. They can get additional amounts under the facility if they increase their lending to businesses. The amount increases 1-for-1 with additions to large business lending. But if they increase lending to small and medium-sized businesses, they can borrow 5 times the amount of the increased lending. So you can see this really is designed to encourage ADIs to support businesses, especially smaller ones, during this difficult period. The window to access these additional amounts closes next March. Based on lending to date, the total of amount of funds currently available under the TFF is around $150 billion. Now, as well as supporting lending to businesses specifically, more generally, the TFF is reinforcing the benefits to the economy of a lower cash rate by providing low-cost funding to banks. By reducing the funding costs of banks, this in turn helps to reduce interest rates for borrowers. This graph shows the cost of banks' various types of funding. The pink line in the first panel is the 3-month BBSW, or bank bill swap rate. A large share of banks' funding costs are linked to BBSW rates, and you can see how they've come down with the cash rate. Moving to the middle panel now, you can see the cost of funding available to the banking system under the TFF at 25 basis points, that's the orange line, is significantly lower than the cost of 3-year funding in the market, which is the blue line. You can see it's also lower than the rate paid on deposits, the red line on the right. So while the costs of banks' various types of funding have declined with the cash rate, the cost of funds from the TFF is lower again. The option of access to this low-cost funding in itself is likely to have put downward pressure on the costs from other funding sources. So the TFF is contributing to a lower cost of funding in the banking system and thereby to lower household and business borrowing costs. Banks began gradually drawing on their TFF allocations in April and have been doing so increasingly in recent months. And they've told us they intend to draw more funds over the coming months. Now, the fourth measure in our package is using our daily open market operations to make sure that there is plenty of liquidity in the financial system. As the dysfunction in markets intensified in March, the RBA responded to the increased demand for liquidity by significantly increasing the supply of liquidity in its daily market operations. This alleviated funding pressures in the banking system, met the increase in precautionary demand for liquidity, and ensured money market rates remained low. Our daily open market operations involve conducting repurchase agreements, or repos for short, where financial institutions essentially borrow cash for short terms from the RBA in exchange for high quality collateral. In March, we increased both the amount and maturity or length of these repo operations, so that by the start of April, $50 billion of additional liquidity had been provided through repos, and the average residual maturity of the bank's repo book had increased to around 70 days. Now, this compares with an average in recent years of around $2 to $3 billion of liquidity at an average maturity of just 1 month. More recently, there's been much less demand for funding at the Reserve Bank's daily market operations. And this is because financial conditions have stabilised and because the liquidity already available to the banking system is now much greater because of our package of measures, including the bond purchases and the TFF that I've been talking about. The ample amount of liquidity in the system means that money market rates have declined to low levels, as you can see from this graph, and this is contributing to low funding costs. So this is the 3-month BBSW rate that I mentioned before, and the rate on RBA repurchase agreements or repos. Now, if liquidity conditions were to tighten up again, for example, because precautionary demand by banks might increase, we would expect to see more demand in our daily operations. And we would meet this to make sure that money market rates and thus funding costs remain low. And that brings me to the final measure in the package, which is related to the now very low level of the cash rate. And what we've done is modified the interest rate corridor system that is used to implement our cash rate target. The RBA has for a long time operated a corridor system to implement the cash rate target. And the concept is set out in this diagram, which shows the quantity of cash on the x-axis and its price, or the relevant interest rate, on the y-axis. Under the corridor system, the cash balances that banks hold overnight in the accounts they have with the RBA, they're called exchange settlement accounts, earn an interest rate 25 basis points below the cash rate target. This is the floor of the corridor, and it's labelled the RBA deposit rate on the diagram. And on the ceiling of the corridor, in the event that a bank needed to borrow from the RBA overnight, it will be charged 25 basis points above the cash rate target. That's the RBA lending rate on the diagram. In this corridor system, banks have no incentive to lend in the cash market at a rate lower than the floor of the corridor, and that's because they could earn more holding exchange settlement balances with the Reserve Bank. And nor do they have an incentive to borrow in the overnight cash market at a rate above the ceiling of the corridor, as they could borrow more cheaply from the Reserve Bank. Historically, within this corridor system, the Reserve Bank has also carefully managed the amount of exchange settlement balances, or system liquidity, so that demand and supply are in balance. This has ensured that the cash rate remained close to the cash rate target. And that's the situation that's shown on the diagram. Coming back to the package now, things have changed a bit from this arrangement. As I mentioned, with the reduction in the cash rate to the very low level of 25 basis points, the Reserve Bank Board decided to increase the floor of the corridor to be only 15 basis points below the cash rate target instead of 25 basis points below. So with the cash rate target now at 25 basis points, instead of banks earning nothing on their exchange settlement balances, they will earn 10 basis points. That's the equivalent of the bottom line in the diagram coming up a bit. Now, this decision was made in light of the significant increases in the balances held in exchange settlement accounts due to the effect of the other elements of the package of policy measures, so the government bond purchases, the TFF, and the additional liquidity operations. Paying a zero interest rate on these balances would have increased the cost to the banking system. And this would be unhelpful in the current environment, where we're trying to lower funding costs and banks are playing an important role in supporting households and businesses through this difficult time. The large increase in exchange settlement balances has also changed the way the overnight cash market operates. So we no longer have the situation shown on this diagram, where the cash rate is very close to the target. Instead, with the supply of exchange settlement balances exceeding demand, the cash rate has drifted below the cash rate target, but remained above the floor of the corridor for the reason I explained before. Now, this has also happened in other economies where there have been large increases in balances held by financial institutions with the central bank, or in other words, large increases in system liquidity. This resulting lower cash rate is consistent with the aim of the policy package of ensuring that funding costs in the Australian economy are very low. As you can see from the graph, financial market pricing suggests that the cash rate is expected to stay around this level for some time, consistent with our forward guidance. So they are the 5 elements of the RBA's policy package. So let's step back now to consider the effects of these measures. Overall, our assessment is that the package is working broadly as expected. It has helped to lower funding costs, as you've seen, and stabilise financial conditions. And it is supporting the supply of credit to households and businesses at very low interest rates. As you can see on this graph, household and business interest rates are all at record lows. So that's what we're doing in terms of monetary policy. But in the current environment, fiscal policy is playing a very important role too. In particular, the government's support measures have been helping to smooth out the very large shock to households and businesses' incomes. So what does all this mean for the economic outlook? Well, even with the help from the large fiscal stimulus and the monetary policy package, the recovery is expected to be slow and uneven, and GDP will probably take several years to return to the trend path expected prior to the virus outbreak. There is a great deal of uncertainty around the outlook. The progress of the recovery will depend importantly on the containment of the virus, the development of vaccines or treatments for it, or countries becoming better at managing its effects. And we just don't know how this will pan out yet. Now, it will also depend on the nature and extent of ongoing fiscal and monetary policy support and behavioural changes among households and businesses. As we've seen, including in Australia, new outbreaks of the virus can flare up very quickly with renewed lockdowns as a result. As well as the direct effects of this on economic activity, in this environment, uncertainty about the future path of the economy, as well as the health situation, is continuing to affect the consumption investment plans of many households and businesses. Given all this, unemployment is likely to decline only gradually, and inflationary pressures are likely to remain subdued for some time because of the spare capacity in the economy. So in the period ahead, the government's ongoing support, along with that from monetary policy, will play an important role while the recovery takes hold. Well, thank you for sticking with me through what I know was a lot of very technical, but I do hope very interesting material. Certainly from my perspective, it's been a really interesting and rewarding time to be involved with implementing monetary policy.